What if I told you that what's happening with AMC right now has little to do with retail selling or bad fundamentals, and everything to do with behind-the-scenes manipulation? Because when you break down the numbers, follow the market patterns, and look at the institutional behavior, there's no other logical explanation. Today, we're going deep into what's really going on with AMC's price action, who's responsible, and why it's happening now. Hey! Welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But everyone, remember this is not a financial advice video. Let's begin with the most unusual pattern we're seeing lately. Low volume trading with massive price drops. Sounds impossible, right? But that's what's unfolding. According to a tweet by Travis, a pattern has emerged that plays out repeatedly. Institutions are loading up overnight, creating artificial long positions, and then strategically selling into bids during low-volume hours. It's like they're passing the same shares around among themselves, just enough to tip the price downward while keeping volume deceptively low. It creates the illusion of selling pressure, but it's far from organic. It's a game being played to mislead the public and shake out retail holders. Now here's the wild part. While the price drops, the actual buying activity is telling a very different story. When you analyze the order flow, larger orders overwhelmingly lean toward buying. Even medium-sized trades show more buying activity than selling. It's only in the small retail trades that we see more sells than buys, and even that gap is relatively minor. More importantly, the total capital inflow into AMC is consistently higher than the outflow. That means more money is entering AMC than leaving it. So why is the price still trending down? Because what we're witnessing isn't a natural market response, it's forced selling pressure via manipulation tactics. One of the biggest culprits? Dark pool trading. Most retail investors can't see what's happening there. Orders don't hit the public exchange, making it nearly impossible to gauge real-time demand and supply accurately. AMC has one of the highest off-exchange trading percentages in the entire market, regularly hovering around 70% or more. That's not a coincidence. That's part of the playbook. Another tool institutions have used to suppress AMC's price is the strategic abuse of FTDs, failures to deliver. These are shares that were sold but never actually delivered, essentially phantom shares that artificially inflate supply. When combined with off-exchange routing, the impact becomes enormous. It suppresses the price while creating the illusion of liquidity. And then there's the sudden appearance of millions of shares available to borrow. We recently saw this number spike to 9 million. But here's the catch. Retail isn't lending out their shares. The majority of AMC's float is held by retail investors who are buying and holding. So how are these new borrowable shares even surfacing? It comes down to three shady practices: rehypothecation, tokenization, and synthetic shares. Rehypothecation allows institutions to reuse the same collateral multiple times. Tokenization introduces digital copies of shares that can be traded in private systems. And synthetic shares, well, those are entirely artificial, but are created through complex derivatives and option trades. All of this combines into one ugly truth. Institutions are fabricating supply just to keep shorting the stock and hold down its price. This isn't just speculation. It's showing up in real-time data and in the financials of the firms doing it. The shorts are struggling. They're operating in a world of tightening liquidity. Their revenue is dropping, debt is increasing, and they're scrambling to sustain operations. Compare that to AMC, where debt has been reduced, fundamentals have improved, and even institutional interest is slowly returning. The contrast is staggering. It's no longer about forcing AMC into bankruptcy. That strategy failed. Retail investors came together and saved the company, not only by holding the stock, but by supporting the business directly. The goal now is to push the price low enough to shake loose those diamond hands, to make investors believe there's no future so that they sell. But the problem is that strategy isn't working either. Every time they drop the price, more apes buy. Every time new short shares appear, long-term holders scoop them up. It's actually backfiring on the shorts. They're spending millions, sometimes hundreds of millions per day to keep up these tactics. Yet the only cost to retail is the price of holding. And holding doesn't cost a penny beyond the initial investment. That's a war short simply can't win forever. Now let's talk about margin debt. This is where things get truly alarming. Margin debt across the board has now climbed to over $1 trillion, the highest in history. That's more leverage than we saw at the peak of the dot-com bubble or the 2008 financial crash. Institutions are so deep in the red trying to suppress AMC that they're borrowing record amounts just to maintain their positions. This kind of leverage isn't sustainable. It never has been. Eventually, it collapses, and when it does, the fallout could trigger the mother of all short squeezes. Travis also recently tweeted something very telling. The shorts are no longer banking on AMC's failure. That plan is dead. Their real fear is that AMC thrives and institutions begin buying again en masse, squeezing the remaining shorts out of their positions. The danger for them isn't AMC collapsing, it's AMC surviving and growing. We're already seeing examples of this shift. Big names like UBS and Virtu, who once thrived in these markets, are now feeling the heat. UBS is under regulatory pressure to increase its margin capital. Virtu's revenues are declining and their debts are swelling. These aren't isolated incidents. These are signs of systemic cracks forming. So where does this leave retail investors? It leaves them in a stronger position than ever before. Holding costs us nothing. Buying is increasing. The data supports our narrative. Every piece of evidence, from inflow-outflow to short interest, to off-exchange trading and margin debt, all points to one conclusion. The AMC price action is artificial. And let's not forget, every time a short sells a synthetic share, that creates another buy they'll eventually have to make to close the position. As more shares get absorbed by apes, the available float tightens. That forces shorts to buy at higher prices later on. This process lifts the floor, meaning the lowest possible squeeze price goes up. We've always said this would take time, and that patience would be our greatest asset. The market is a battlefield, and the opponents are well-funded and well-connected. But they're also desperate. Desperation leads to mistakes. Mistakes lead to exposure. And exposure forces action. Every voice that speaks out about these manipulations, every ape that continues to hold, every investor who sees through the lies, adds pressure to a system already stretched to its breaking point. So the next time someone asks you why AMC is falling while buy volume rises, or why so many articles claim AMC is dying while retail keeps pouring in, just tell them this. It's not about fundamentals. It's not about selling. It's about power. And the apes are holding it. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.